As we all know, candlestick charts display the high, low, open, and closing prices of a security for a specific period. It has common individual patterns and common blended patterns, and in this part of the video we will tackle about the common blended patterns in candlestick charting. The different common blended patterns are Haramian engulfing candlestick pattern, dark cloud cover and three black crows. Harami candlestick pattern can either be bearish or bullish depending on the direction of the price action. The bearish Harami candlestick pattern is a 2-bar Japanese candlestick pattern that suggests prices may soon reverse to the downside. Each pattern of bearish Harami consists of 2 candlesticks that occur on successive days. It occurs at the top of an uptrend when there is a large bullish green candle on day 1 followed by a smaller bearish or bullish candle on day 2. The most important aspect of the bearish Harami is that prices gap down on day 2 and were unable to move higher back to the close of day 1. This is a sign that uncertainty could be entering the market. A bullish Harami is a candlestick chart indicator suggesting that a bearish trend may be coming to end, which is generally indicated by a small increase in price, signified by a wide candle, that can be contained within the given equity's downward price movement, signified by black candles, from the past couple of days. Take note, a bullish Harami occurs at the bottom of a downtrend when there is a large bearish red candle on day 1 followed by a smaller bearish or bullish candle on day 2. In contrast of bearish Harami candlestick, the most important aspect of the bullish Harami is that prices gapped up on day 2 and the price was held up and unable to move lower back to the bearish close of day 1. Bearish Harami first established uptrend. Second is leading larger bullish, green, candle. Third is trailing smaller bearish, red, candle. Price gaps down after bullish candle and is contained within the open and close of the leading bullish candle. Third trailing smaller bullish, green, candle. Price gaps up after bearish candle and is contained within the open and close of the leading bearish candle. Engulfing candlestick patterns are comprised of 2 bars on a price chart. They are used to indicate a market reversal. The second candlestick will be much larger than the first, so that it completely covers or engulfs the length of the previous bar. It can also be bearish or bullish engulfing pattern. A bullish engulfing pattern is a candlestick pattern that forms when a small black or red candlestick is followed the next day by a large white or green candlestick, the body of which completely overlaps or engulfs the body of the previous day's candlestick. Bullish engulfing patterns are more likely to signal reversals when they are preceded by 4 or more black candlesticks. Take note that if you are an investor you should look not only to the 2 candlesticks which form the bullish engulfing pattern but also to the 4 preceding candlesticks. A bearish engulfing pattern is a technical chart pattern that signals lower prices to come. It is the opposite of a bullish engulfing. The pattern consists of an up, colored with white or green, candlestick followed by a large down, colored with black or red, candlestick that eclipses or engulfs the smaller up candle. It comprises of a short green candle that is completely covered by the following red candle. The pattern can be important because it shows sellers have overtaken the buyers and are pushing the price more aggressively down than the buyers were able to push it up. Take a note that a bearish engulfing pattern can occur anywhere, but it is more significant if it occurs after a price advance. This could be an uptrend or a pullback to the upside with a larger downtrend. Key takeaways for engulfing pattern. First, engulfing candlestick patterns are comprised of 2 bars on a price chart. Second, they are used to indicate a market reversal. Third, the second candlestick will be much larger than the first, so that it completely covers or engulfs the length of the previous bar. Fourth is a bullish engulfing pattern will be made of a shorter red bar being engulfed by a longer green bar. This indicates a bearish trend is coming to an end, ready for an uptrend. Fifth is a bearish engulfing pattern will be made of a shorter green bar being engulfed by a longer red bar. This indicates a bullish trend is coming to an end, pattern ready for a downtrend, typically black or red, opens above the close of the prior up candle, typically white or green, and then closes below the midpoint of the up candle. Take note that the pattern is significant as it shows a shift in the momentum from the upside to the downside. The pattern is created by an up candle followed by a down candle. Traders look for the price to continue lower on the next, third, candle. This is called confirmation. Also, take note that the first candle should be green, which is bullish, and the second candle should be red, which is the bearish one. Both candles should have a big real body. 3 black crows is a phrase used to describe a bearish candlestick pattern that may predict the reversal of an uptrend. Candlestick charts show the day's opening, high, low, and closing prices for a particular security. For stocks moving higher, The candlestick is white or green. When moving lower, they are black or red. Take note that the Black Crow pattern consists of 3 consecutive long-bodied candlesticks that have opened within the real body of the previous candle and closed lower than the previous candle. Often, traders use this indicator in conjunction with other technical indicators or chart patterns as confirmation of a reversal.
Thanks for watching.